Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning from me, Peter Lewis, and a warm welcome to Money Talk for Thursday, the 11th of May. Just a reminder that we're on iTunes, Spotify and Google Podcasts. If you go to my website, peterlewismoneytalk.substack.com, you'll find all the links to your favourite podcast apps. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, inflation in the US has dropped below 5% for the first time in 2 years. The annual pace of consumer price inflation dipped slightly from 5% year on year in March to 4.9%. That's the lowest since April 2021. Economists had expected it to remain steady at 5%. However, core inflation, which excludes food and energy, remains sticky, ticking down to 5.5% in April as expected from 5.6% in the prior month. But it's barely moved since the end of last year. In a surprise move, China has named little-known Li Yunze as chief of the new financial super regulator, the National Financial Regulatory Administration, which will oversee the $61 trillion financial sector. The enlarged national regulator was unveiled in March, and the new regulatory body will replace the CBIRC and oversee all financial activities except the securities industry. Mr. Li is a former banker, and his last post was Vice Governor of Sichuan Province, where he's served since 2018. The US Audit Inspector, the Public Company Accounting Oversight Board, said Wednesday it found unacceptable flaws in audits carried out by PwC and KPMG in China. The PCAOB found deficiencies in 4 out of 4 audits it examined by KPMG Huaozhen, the firm's mainland China operation. 3 out of 4 audits by PwC's Hong Kong operation contained flaws. The inspections were the first carried out by the PCAOB in Hong Kong of the work of auditors on US-listed Chinese companies, following an agreement last year with Beijing whereby US regulators were allowed to inspect the work of auditors in China for the first time. Google has launched a revamped search engine powered by artificial intelligence to catch up on lost ground with Microsoft's Bing. The new version will initially only be available in the US through a waiting list system before being rolled out more widely over the coming months. Google is also updating Gmail, Google Docs and its Bard chatbot to use its language AI model Palm 2, which was also launched on Wednesday. On today's Money Talk, we're joined by Andrew Freris, CEO of Ecognosis Advisory, Mark Toe, Managing Director of Asset Management at Fung Financial Group, and Raymond Yeung, Greater China Chief Economist at ANZ.
Peter Lewis's Money Talk.
US stocks posted modest gains in a lacklustre session after inflation moderated slightly in April. The S&P 500 wavered between gains and losses before ending Wednesday's session up 0.4% at 4,138. The Dow edged down by 30 points, or 0.1%, to 33,531. The Nasdaq Composite Index added 1%, closing at 12,306. Volatility tumbled on the day, with the CBOE VIX falling 4.4%. Chinese stocks extended their losses from Tuesday. The Hang Seng dropped 105 points, or 0.5%, to 19,762. The tech index rose 0.33%, and this morning futures markets are pointing to a small gain of around 20 points for the Hang Seng at the open. On the mainland, the Shanghai Composite tumbled 1.2% to 3,319, and the index reached 10-month highs earlier in the week. China will release its April consumer price and producer price inflation data later this morning. Economists are expecting a 0.3% year-on-year rise in the consumer price index, which, if correct, would be the lowest rate since February 2021. China's consumer inflation stood at 0.7% in March. US Treasuries held on to their gains after the inflation data. The yield on the 2-year Treasury note, which is particularly sensitive to monetary policy expectations, fell back below 4%, down 11 basis points at 3.92%, and the rate on the 10-year declined 8 basis points to 3.44%. The US dollar index fell to a 4-week low before rebounding slightly to end the day down 0.2%, and it's close to going negative for the week, which would make it its third losing week in a row. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's time to welcome our guests, and I have with us our regular Thursday commentator, Andrew Freris, the CEO of Ecognosis Advisory. Morning to you, Andrew.
Morning with them.
And also with us is Mark Toe, who's Managing Director of Asset Management at Fung Financial Group. Morning to you, Mark.
Good morning.
And we also have with us Raymond Yeung, who's Greater China Chief Economist at ANZ. Very good morning, Raymond.
Good morning.
Let's start in the US with that inflation data. Inflation's dropped below 5% for the first time in 2 years. The annual pace of consumer price inflation dipped slightly from 5% year on year in March to 4.9%, the lowest since April 2021. Economists had expected it to remain steady at 5%. Food prices grew at a slower rate of 7.7% versus 8.5% in March. Energy costs fell further, declining 5.1%. Shelter costs, which accounts for over 30% of the total consumer price index basket, slowed for the first time in 2 years to 8.1%. Compared to the previous month, the CPI rose 0.4%, which is much higher than 0.1% in March, but did match market expectations. However, core inflation, which excludes food and energy, remains sticky, ticking down to 5.5%. in April 2023, as expected from 5.6% in the prior month, but it has barely moved since the end of last year. Andrew, maybe I can ask you to kick off. I have to confess, I'm struggling to get excited by a 0.1% drop in inflation from a year ago, but I suppose maybe I'm being a little bit ungrateful here, and it's a step in the right direction, but what do you think? Tell me I'm wrong.
I prefer very basic Mickey Mouse calculations, not because they are necessarily correct, but because it's the best that I can do. And that is, it took approximately a year of increases of interest rates from 0 to 5% for inflation to come down from, I've forgotten now what was a high 8 down to 5. And presumably the Fed would like to see it go down to 2. If I did a very, very simple calculation of each time the Fed increased by 25 basis points, X percent points fell on inflation, then perhaps we might need several more 25s to start bringing it down to 2. I'm not suggesting that this is pari passu. In other words, one step at a time brings immediately inflation down. Might be as much as 6 months. But if the Fed is deadly serious about the 2%, then there are still 300 basis points to go. And hence, that was a very small drop, but it was a drop, and that was interesting. But I don't think in any way, if one does a very simple calculation, means that the Fed has now stopped. So the notion that in June they are not going to increase interest rates, I think it's very premature. Actually, that's a very fine way of saying, I think in June the Fed will increase.
Okay, Raymond, what are your thoughts on this? It's coming down, isn't it? But it seems painfully slow.
Perfect. I agree with Andrew's diagnosis that the Fed has increased a lot, but then the inflation has come down a little bit. If I look at this core CPI, it's even more worrying. It's still hanging around 5.5% last night. So that's an indication that the Fed is not really that effective in bringing down what we call the supply side driven inflation. To be honest, that the wage inflation remains very strong, and the labor market numbers is not really encouraging from the Fed point of view. It's 3.4% unemployment at the moment. And if you compare this core CPI with the pre-crisis or even the pre-trade war scenario at that time, we just talked about 1.8% of core CPI, but right now we're still at 5.5%, so it's not really that encouraging. So I would just ignore the headline CPI, but more on the core one.
So how on earth does the Fed, it seems that maybe the easy work in getting inflation down has been done. How on earth does it get down to its target of 2%?
They got to do more. So I just agree with Andrew that even though the market is now even expecting some cut, or the turn or the rate cycle before the year end. But look, I think it's pretty clear that the Fed is holding this adaptive strategies, this data-driven approach just in life because of this banking crisis. So they just want to think about it again before perhaps even to restart the tightening cycle again. Never know.
Mark, back in the days when I was an equities trader, I was always told by my bosses, don't fight the Fed. But the markets seem to be fighting the Fed at the moment, month after month after the month. They're calling for maybe 50, 75 basis points of rate cuts by the end of the year. The Fed, in speaker after speaker, is adamant that that's not going to happen. So what's going on here?
I tend to think that the market, the market participants are actually way beyond the wisdom of the technocrats, but I think it is not. We should not blame the Fed officials simply because of this, because that's the nature. They have to look at the data. They have to make decisions based on the subjective data. Otherwise, the political pressure will be overwhelming for them. And I tend to think that at this moment, at least for the past few years, based on the COVID pandemic, somehow the inflationary pressure is not really easy to tackle with. First of all, we have the money supply, significant changes in money supply, both from the days of since financial tsunami as well as in the COVID pandemic. And that complicated issues, and also because of the supply side factors. But at this moment, I don't think that they will raise by too much, to tighten too much, especially given the market expectations, whether in a rate cut, which is not really likely in the foreseeable short term. But overall speaking, the market has a lack of trust. That is to say the least.
I mean, the markets for the whole of the year, haven't they? Have almost been sort of cheering as if we're out of the woods on the inflation front. But as Raymond and Andrew have just been saying, we're most definitely not out of the woods. So you feel that at some point something's got to change. Either the Fed is wrong and they panic and suddenly slash rates, maybe but they only ever do that, don't they, when there's some sort of crisis, or the market is wrong, in which case when there is a repricing of investors' expectations, we're going to see some massive volatility. So, do you think that's the risk for us?
I'm sorry. I tend to think that, in a sense, logically speaking, we can all both be wrong at different time for different reasons. For different reasons. For example, of course, the expectations management between the Fed officials and the market participants have been working quite well in the before the pandemic, but after that, I think that the Fed officials have been lag behind the curve so much that every step seems to be offbeat, and the whole game is not easy to be remedied at this moment. We just wait and see. But somehow it is just like two extremes. On the one hand, the market participants may seem to be forcing some kind of a self-fulfilling prophecy to have changed the whole game, the rules of the game, and to make sure the Fed officials to abide. But it is not quite easy for them because they have their own agenda somehow.
Andrew, obviously out here, investors are focusing on these Fed inflation numbers very carefully, and also the jobs report as well, which, as you mentioned earlier, we saw an unemployment rate at the lowest level since 1969. What are the implications here in Hong Kong of what's going on in the US with inflation?
Well, my answer is going to be two parts. First is if I look at my trusty Bloomberg screen, where all the major and minor stock markets, both in Asia and in the G20, it is absolutely dominated by green, and that is year-to-date increases in US dollar terms, except Malaysia here. And Thailand. Except Malaysia and Thailand that have got elections coming. That makes some sense. And, of course, good old Hong Kong.
Yep.
Well, in the case of Hong Kong, of course, more increases in interest rates. But with a peg, this is not a matter whether Okay, but it is a matter when. So the answer is today. I wish the news were good enough to say perhaps this is going to lift a little bit the pressure of Hong Kong, and the answer is no, it will not, assuming that I'm right. Okay, that interest rates will increase. So the answer is today is not a day of good news for Hong Kong.
Raymond, what are your thoughts? We got obviously inflation data coming out of the mainland today. We got the consumer price and producer price numbers. I think the consensus estimate is for about 0.33% year-on-year rise in the CPI, which would take it to the lowest since February 2021. If consensus is correct, what are your expectations from the data today?
Correct. You point out a very important fact that is clearly an inflation divergence between China and the rest of the world, the U.S. in particular. You talk about the CPI number today is less than 50 basis points. This market's looking at 0.3% increase. But we have been, I think perhaps I might be the first one to call the market to focus more on the PPI number, which is still in contraction, in even a larger degree of contraction today. Market is looking at 3.30, but our house looking at 3.5% reduction in PPI compared with last year. So to some extent, we know that the demand side in China is very, very weak. We talk about the U.S. unemployment as historically low, in the year that when I was born. Then now that we look at this China unemployment number, last month is 19.6% for the youth unemployment. So clearly, you see that it's a huge divergence in terms of domestic demand condition. And in fact, if you mention about the impact on Hong Kong too, with your discussion with Andrew here, I look at it as, hey, what if another 25 basis point high? Of course, that the banks are not really trying to match with the same degree of increase in the prime rate. But then what happened yesterday, especially in the Hong Kong dollar market, is started to deviate back from the upper bound, 7.85 to 7.83 now, with the fact that because of the local interest rates trying to catch up with LIBOR, we got SOFR now. And that Hong Kong's HIBOR still lower than the U.S. counterparts, and it needs the Hong Kong rate, the HIBOR, to come up stronger or higher than LIBOR, so that the cost of carry will start to help stabilizing the Hong Kong dollar away from the bond. So this is what we're expecting over the next few months, that even with a peak of the U.S. tightening cycle, but then the Hong Kong dollar market still have a long way to go to match the U.S. counterpart.
But the peg is a sort of self-reinforcing mechanism, isn't it? So in effect, it's doing its job. What's supposed to happen is happening. Funds leave Hong Kong, or they go into U.S. dollars, and then that rate starts to close, and we see things come back.
It's all driven by the interest rate differential, though, right? Because the HIBOR is lower than LIBOR currently. So it just needs to be whatever the Fed fund rate is, and also Hong Kong base rate. But then in the market, we look at the cost of carry. And this is more to do with whether the liquidity condition in Hong Kong is tight enough so that HIBOR can go back to above LIBOR. And that would help the peg stabilize within the band.
Mark, one other thing going on in the US that I wanted to raise that's obviously having an impact, particularly on the bond markets, is these debt ceiling discussions. They broke up a meeting at the White House on Tuesday without any agreement on raising the debt ceiling. Janet Yellen says there's going to be an economic catastrophe if it's not raised. But we're also seeing kinks now in the bond market, very short-dated Treasury notes, which expire in around just over a month's time. Yields are trading at record highs there, and credit default swaps are pricing in now the highest probability on record of a US default. How much should we be watching this and be concerned by it?
Yeah, I have a rather optimistic view of this because given the reality there's no, as Yeung said, there's no real good option. The only way out is to raise to lift the ceiling, and whether it is voluntarily done by everyone or involuntarily, and I think that is the end game, and most of the if not all of the people involved are actually quite aware of this. But in between, during the process, it could be quite painful for people to keep troubled by all these things. And I think the investor sentiment at this moment is not really that optimistic, not as optimistic as mine, because we have all sorts of problems happening at the same time. Whether it is inflation is good, it is falling, and we have the unemployment. No, not actually, but the recession risk, as indicated by the yield curve, somehow the inversion still trouble a lot of people, and now we have the debt ceiling. So overall, don't forget the bank failures. I think all these sorts of problems make the trilemma of the policy making for the Fed officials really complicated. So at this moment, investors, at least for me as a fund manager of a global macro fund, I will be very, very careful on the bond positions and even for the stock positions. So at this moment, I think it is quite legitimate for people to go bullish on gold and also Bitcoin or all sorts of alternative investment, even though it is not quite like the zero interest rate environment in the past few years.
Andrew, when we've talked about this the last couple of weeks, you've been resolutely unconcerned. Now today, the cost of insuring against a US default in the credit default swaps market will cost you more than Greece defaulting. What do you say to that?
Well, I'll go back again. I'm sorry, my needle is absolutely stuck because clearly it shows my age. You know, I've seen it so many times over so many years and so many occasions. Going back to year 2000, again. That takes care of all the millennials around there. There has been at least 8 occasions on which the United States almost defaulted. At least 3 of those, the government actually sat down. I will repeat that very slowly. I might be wrong on the actual number. It will be not less than 2, possibly not less than 3. They actually sat it off. They said, Ministry of Agriculture, closed. Ministry of, except the Defense Department, okay, and then the Treasury found ways in which they could extend the period in which they will carry on funding without increasing the debt limit for 2 more months. So in other words, I have no idea what is the game that is being played there, because looking at the cuts that the Republicans are wanting, it's not the kind of thing, you know, less money on abortions and less money on gender equality. It's not as simple as that to make it crude. So I'm afraid I'll have to remain nonplussed on that. Okay. It happened 8 times at least, and it's going to happen again.
Well, we shall see. We're coming up to this June the 1st that Janet Yellen says is the deadline, but we shall see over the next coming weeks. Raymond, I want to switch to China, get your thoughts on some of the data that we've had this week out of the mainland. I think probably the most startling piece of data was this trade data, and particularly imports unexpectedly shrinking almost 8%, 7.9% year on year in April. That compares with a 1.4% drop a month earlier. And this is now the 7th straight month of falling imports. And South Korean exports to China, in other words, Chinese imports from South Korea, which is sort of a leading indicator of China's imports, down 26.5%. This is rather concerning, isn't it?
Correct. It's more about the supply chain. For the import side, it's also a lot to do with the very weak domestic demand. The Korean export number, and as well as, for example, even the Taiwan export number are all dropping. So if you look at the mainland number, of course, it is a bit surprised me that it's not a double-digit increase. Because of the base effect last year after Shanghai lockdown in April, then a lot of people at least expect a double-digit number in terms of the headline growth compared to the same month last year, but it's only have having a 8% increase. Import size, the actual number is just $205 billion US dollar. It's a 10% drop compared with last month. So it tells you that even though everybody is looking at the China reopening, can have a decent recovery, but the recovery so far has been very two-speeded, which means that the service sector, domestic travel, all the pictures you've seen on WeChat and can tell you is a lot of people are traveling domestically, but the reality is that manufacturing PMI is coming back to below 50, and industrial profits also been falling to more than close to 20% decrease in industrial profits too. So it tells us that the imports number is clearly reflecting a very poor and weak domestic circulation, from the terminology, by the terminology of the central government.
And are there any signs that consumer spending splurge, particularly, immediately after China reopened and then also over the Labor Day holiday, is running out of steam? And if it does run out of steam, given that manufacturing is in the doldrums, what's going to drive the Chinese economy forward?
It's only leave it to the only pillar here is investment. Now, the investment number, the FAI, that we are going to see next week, expecting a FAI number will be out, but that we're still looking at below 6% of the fixed asset investment increase this month. And bear in mind that last year, again, have to reiterate this point, that the April number, we have to take it with great caution because of this base effect from Shanghai lockdown last year. And just 6% increase in the fixed asset investment is not really a decent number, to be honest. And also look at that. I look at the last month's number, and even with a 5.1% in FAI, but 10% came from state-owned companies. The private sector's investment is 0% increase, and this is a nominal number, not a real growth. So it tells us that the investment sentiment in China is not really that great. But this is only pillar now the government can count on, despite all the stimulus and special local government bonds issue that may help some infrastructure investment. But overall, the number still pretty sluggish,
So does it mean stimulus is coming? Is more stimulus coming?
No, I don't think that they can do more. They have done everything. It's just the only thing that they have not done and really, giving it tightly is the housing policy. So we really need to see any sign of change in the policy tone towards a more relaxing housing policy, so that they can name it as a property policy, not just a housing policy, that can lead to people think about, property is still an investment goods, not just for housing. So this is the policy reality right now that hindering the broad-based recovery of not only the economic number but also consumption and whether China can get away from this deflationary trap.
Mark, what are your thoughts on this? Do you see this trade data that we saw out of the mainland as a warning for what's going on the mainland economy?
It has always the negative impact on investment investor sentiment because of these data, but. Then again, for all those years, I think the Chinese, the financial authorities, they have been trying hard, and I agree with Raymond that they have tried everything. I think to get help from all these things. So at this moment, I think. Comparatively speaking, they are not that bad. If you look at all the crises in the global markets, I think they are still manageable. But of course, it is not good. It is not quite as good as maybe compared to 10 years ago or so. So it's just a very harsh reality that high growth rate in the past few decades have to slow down somehow. It is not without painful lessons.
But the authorities seem very concerned, don't they? Every time you hear government officials speaking, they talk about the unbalanced economy. They're concerned about consumption not holding up, particularly in rural areas. So what do you expect them to do? Mark?
They are, yeah.
Mark?
Raymond? I tend to think that the government, at least for the moment, they will acknowledge that they have tried most if not all of the possible strategies, and now maybe they may have to they may have to change some personnel, they may have to change some superstructure to signal something to the market. But I tend to think that they have tried everything possible, and let's play with the time.
Okay. Andrew, let me get your thoughts about Taiwan, because we had that Taiwan export data as well. Taiwanese exports down for the 8th straight month now, dropping 13.3%, although that was a bit slower than the 19.1% plunge in the previous month. Obviously, Taiwan, very trade dependent. Exports account for about 70% of Taiwan's economy. Is this reflecting basically what's going on sort of globally? There's a slowdown in global demand, particularly for semiconductors, and also, of course, we've got the impact of the chips war between the US and China.
Yeah, exactly. The key exports out of Taiwan is microchips, semiconductors, and there has been a significant drop in the demand of those for two reasons. One is, of course, post-COVID. During COVID there was a surge in the demand for, let's say, communications equipment. In other words, that would have included not only handheld devices, but of course also mobiles. All right, now, post-COVID, there has been a significant drop, and that was reflected on the demand for semiconductors. That's point number one. Point number two is that the variations in the demand for the individual chips, in other words, we treat semiconductors as if they are, let's say, food. Okay, well, no, food is dairy and meat and bread and milk and 101 different products, and so is semiconductors. And there has been a significant focus now on what's happening with the AI and the chips that are, let's say, appropriate for the AI. And this is another aspect where both Japan and Korea have made very significant inroads. You know, I always tend to forget that Japan is also one of the major producers of semiconductors, and therefore it is in par with competition. And last but not least, is the yes and no positions of Taiwan vis-a-vis the kind of exports that of microchips that the rest of the G20 economies are now quietly restricting and forbidding to go to China. This is an area which I've tried to find out if Taiwan is in any way encircled in that particular little game. In other words, you can't export certain kinds of microchips to China that other countries are doing. I must admit, this is ignorance on my part, but I would not be surprised if this is an element that impacts it. And last but not least, of course, the likelihood that the elections at the end of the year are not going to be China favorable.
Okay, Raymond, what are your thoughts? I mean, this data that we see, not just Taiwan, actually South Korea as well, isn't it? It seems to be a window on the state of the global economy.
You look at the SIA global semiconductor sales number. Last month is dropped below $40 billion US dollar. Those are global sales of semiconductors. Compared to last year, the number was 50. So we talk about a 20% decline in the semiconductor, and I believe that the cycle has not bottomed. So we have to wait for a few more months for the semiconductor cycles to bottom out, probably by the end of the year. And this is clearly not only because of the demand, weak demand, or the possible economic slowdown of the advanced economy, but also from supply side point of view, whether there are new product that can drive new demand, because this is more a supply-driven segment. That if we see a new model of a new mobile phone, then that can help but it just seems to us that it has already reached a point that lack of innovation that might not be able to drive a strong demand again. Talk about this, the deviation stops the demand between China and the rest of the world. We also know that own domestic supply of low-level chips started to gain traction, so that they can less relying on the supply from the other advanced economy too, and also the shift to this advanced computing is clearly a new phenomenon that will probably less relying on a massive volume and massive amount of low-level chips, but more more sophisticated and high-precision chips. This is not my area, but that's what I've heard from the industry expert, that would create some dynamics and in the end affecting Korean and Taiwan export numbers.
Okay, Mark, final word to you. Let me switch to the markets. What's going on for Hong Kong stocks? Down 14% now, the Hang Seng from the year high back in January. What are your thoughts on the outlook?
During the last 2 months or so, I think basically it is just range-bound trading within for Hang Seng Index 19 to 21. I think it's just a very and with a thin market. So basically, you see all the technical indicators, the SMAs are moving together, and it is very easy to have some kind of breakout, whether it is on the upside or the downside. But the signals are quite misleading. So basically, I think if we can't really recoup the lost territory on 20,000 handle, it is more likely to test the support at 19. And at this moment, the sentiment is not quite good, and there is no significant positive impact on both sides, whether it is on the mainland or on the U.S. economy. So basically, I think it is more likely to test the support.
Okay, well, thank you very much. Thank you all very much. You heard there Mark To, who is Managing Director of Asset Management at Fung Financial Group, Raymond Yeung, who's Greater China Chief Economist at ANZ, and our regular Thursday morning contributor, Andrew Freris, who is the CEO of Ecognosis Advisory. Thank you very much for listening today. Please take a look at my website, peterlewismoneytalk.substack.com, where you'll find a lot more information in my daily newsletter about the topics we've discussed on this episode. On tomorrow's programme, I'll be talking with Francis Lund, the CEO of Geo Securities, and William Ma, Chief Investment Officer at Grow Investment Group. And with a view from Australia is Toby Lawson, Director at Staten Advice. Please join me tomorrow.
Money Talk